Hey everyone, welcome to my dividend investing guide. This guide is for beginners and advanced dividend investors as well, for investors that want massive cash flow and passive income from their dividend investments so they can spend time like I am right now on the beautiful island of Maui, Hawaii. This is my video from Kaanapali Beach. I'm so excited. I'm staying at the beautiful Westin Nanea. I got up a little bit earlier today to do this video for all of you. I'm going to cover 13 different stock market metrics. I have my handy notebook here. It's been a while since I've used this. Please smash the like button if you've been around since the notebook days. And I hope you enjoy today's dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, I am so excited about the video today. Please smash the like button if you enjoy tropical destinations as much as I do. And please go ahead also and subscribe because I have so much content on the way. I'm going to go through the 13 metrics. The first one is PE ratio. And so as a dividend stock investor, I invest for dividends and cash flow. One of the things that's really important to me is I like to buy value. I like to buy stocks when they're trading at a reasonable value. How do I assess the value of a particular stock? Well, I look at the PE ratio. The PE ratio is calculated as the price per share divided by the earnings per share. And so if I just take what the stock is currently trading at and what it has earned, say in the last 12 months, I'll get the trailing 12-month PE ratio. But for me, I actually like to look at more of a forward PE ratio. And so what I'll do is I'll look at, hey, what is the stock trading at now? What is the stock going to earn this calendar year, say 2021? And then I'll look at the forward PE ratio. That gives me a better sense of actually where the business is headed. Now, PE ratios can range all over the place. For the traditional, say, energy industry, I wouldn't want to pay a PE ratio much more than 15 when I buy a stock. But for something like Apple, for example, which is a high-tech company that I own, maybe I would pay a PE ratio as high as, say, 25 because it's a growth company, it's growing quicker, and so those earnings per share, the denominator is growing quicker, and so that forward PE ratio, it's just going to keep going down and down and down. Whereas in the energy industry, with earnings more stable, the PE ratio that you get from the get-go is probably what the PE ratio is going to be for a while. And so PE ratio also takes into account not only industry group, but also growth rates. And so those industries that tend to have a slower growth rate will have lower PE ratios. But it's a great sense of value and entry point. And right now, say for a consumer packaged goods stock, I'm buying Campbell's Soup right now. For that particular stock, I really like the PE ratio in that 15 range. I feel that that's a value. But if it got up much higher, say to a 20 or even an 18, it wouldn't be as much of a value for me. And so that's PE ratio. I want to go into the second metric in the video today that I use as a dividend stock investor. These are great metrics when you're starting out or if you're an advanced dividend investor as well. These are just 13 metrics that help me screen any dividend stock. And the next one that I look at is obviously the dividend yield. I am a dividend stock investor, and so certainly I need to look at the dividend yield. I need to understand how well the stock is doing from an interest standpoint. And so what dividend yield is basically if I take the dividend per share, I can get that on an annual basis by just looking at the quarterly dividend and multiplying by 4. What I can then do is I can take that and divide by the share price. And so let's say you've never invested in dividends before, you're new to this. Dividend yield is a very similar concept to say just the interest rate on an interest-bearing, say, money market account. Dividend yield gives you a sense for every $100 invested, how much cash flow are you going to get per year in dividends? And so a 3% dividend yield, for example, would be $3 per year in cash flow for every $100 invested. Now, what's so great about dividend yields is they're kind of locked. When you buy the dividend stock, you have a starting yield that's locked, but basically dividends on world-class companies that I like to buy, like Apple, for example, they go up over time. And so whereas the starting dividend yield might not look that attractive, if I hold the dividend stock for long periods of time, like 10 years, 20 years, that dividend on yield on cost will be higher than the starting dividend yield. And so I do a lot of videos here on my YouTube channel. Make sure to subscribe, all about yield on cost. I did a complete video, one of my first videos, that's a model on this, and I will link to that in the description below. It's definitely worth checking out. But that is the miracle of dividend investing, is I could start at a dividend yield of 3%, and over time, if the company I own keeps raising the dividend over and over and over, say 5-10 years out, that 3% starting yield could be up to maybe even a 10% dividend yield on cost. And that's why, just like being here in Hawaii, walking the beach, understanding, just you take a bigger, high-level perspective, you look at nature, and you realize everything is about the long term, and that's just what dividend stock investing is. It's a stock market investing strategy. It is get rich slowly. It is about the long term, and that's the power of dividend yield on cost. I want to get into the third metric that I look at today as a dividend stock investor. That one is compound annual growth rate. And so I want to actually put that formula on the screen right now. And compound annual growth rate is a really helpful formula that when I look, say, at 5 years worth of data, and the one I'm starting with here is the 5-year compound annual growth rate, it tells me on average, if I give it 5 years of data, what is the growth rate on average per year. And I like to look at 5-year compound annual growth rate for the dividend, because I like to invest in dividend stocks that increase the dividend over time. And so a compound annual growth rate applied to the dividend over 5 years is really helpful to understand, hey, are they raising the dividend on average by 7% or more? Those are the stocks I love the most, because those stocks will give me a really high dividend yield on cost. But I also apply the compound annual growth rate formula to revenue, and I apply it to earnings as well, net income, earnings per share. And the way I do that is I pull the revenue for the 5-year period from the annual reports that the companies provide, which are available on the investor relations websites from these companies. And I pull the earnings per share, again, from the annual reports, and I apply the 5-year compound annual growth rate formula to it. Now, the beauty of doing that is it tells me on average, hey, how much are they increasing revenue per year? Revenue is the same as sales. Or, hey, how much are they increasing per year the earnings? And what I want to do is I want to understand, is it at least, say, 5% or 7%? Because if it's not, how are they going to increase the dividend on a year by year basis of, say, 7%, which is a sweet spot that I like to target? They're not going to be able to do that unless they're increasing the top line revenue and certainly the bottom line net income, the earnings per share. And so it's really important to look at a compound annual growth rate on metrics other than the dividend to understand if the dividend growth is sustainable. What I also look at, and I'll put the formula on the screen right now as well, is the 10-year compound annual growth rate. And I like to look at 5-year because it's more recent history, but I like to look at the 10-year as well because it gives a sense of, hey, the longer term, what's going on with the company over the longer run, and are they able to sustainably increase not only the dividend, but the revenue? Are they able to increase the earnings over the long run? And I want to understand a compound annual growth rate for that. And I do most of my analysis on compound annual growth rate. I use the formula that I'm including on the screen here. I use that in Excel, and it can be applied to other metrics as well. And so it doesn't only have to be revenue, it doesn't only have to be earnings. You can apply a compound annual growth rate formula even to something like gross margins, just to see over time, are the gross margins expanding, are they contracting? Gross margins is basically the margins. I'll get into this as a metric I like later, but it gives a sense of how expensive it is to produce the product or widget that the company is producing. And over time, I like to see margins pretty steady. I like to see margins that are expanding, because when a margin expands, it really shows a sign of a competitive moat. And so I'm spinning around here as people walk by, and I'm trying to keep them out of my video. So let me go here for the notebook again. And so there we go. The next one I want to look at, this is metric number 5, is the years of dividend increases. And so as a dividend stock investor, I realize I'm not going to retire and live a life of luxury here on Hawaii if I just buy Campbell's soup and it pays a 3% dividend yield, or 3.2, somewhere around there right now, and it never increases. And so what I like to look at is I own 51 dividend stocks. I generally like to include companies in my portfolio that like to increase the dividend over time. And so I look, when I'm buying a dividend stock, How many years has the company increased the dividend consecutively? How many years has it done that? And there are two buckets and special classes of companies that I like to look at as a dividend stock investor. The first bucket is called dividend aristocrats. You've probably heard this term somewhere online. A dividend aristocrat is a member of the S&P 500 that has increased the dividend by 25 consecutive years. They've increased it annually each year like clockwork for 25 consecutive years or more. There's another bucket that's even more special, and it's called dividend king. A dividend king has increased the dividend by 50 consecutive years or more. And so these are the companies that I like to own because I realize I can buy it right here, and over time as they increase the dividend year over year over year, and as I reinvest my dividends year over year over year, as I keep adding money, as I hold for the long term, this snowballs into a compounding effect where my dividend yield on cost, it might not be 3%, it might be 10%, 20%, or even more. And that's the magic of dividend investing. Dividend investing works because when a dividend investor buys world-class, stable companies that can increase the dividend year over year over year, the yield on cost can get really high. And it just takes time, it takes patience, it takes perseverance. And so I love to understand these metrics when I'm getting into a dividend stock, just to understand, hey, how is it going to do in the future in terms of giving me a pay raise? That's really how I look at dividend aristocrats, dividend kings. These are stocks over the long run that consistently give investors a pay raise. They give investors more money each year for doing nothing passively. And so I'm spinning around here as people walk by. Busy day, that's something I found this year in particular, coming here in June. It's definitely a more busy time of the year for Kaanapali Beach. And I think with the pandemic kind of ending, everyone is out and about. And so what I want to do next is I want to get into metric number 6. This is gross profit margin, and so I hinted at this earlier. I pull this personally from the annual report. The way that I pull this metric is I basically take what is the gross profit. Gross profit is basically how much the company makes after cost of goods, so it's how much it costs to produce the widgets that they sell. And then what I do is I divide that by revenue or gross sales, and it gives you the gross profit margin. I like companies that have a good gross profit margin, that hold it steady over time. I don't like to own companies as much that have a weak gross profit margin, because the lower the margins, there's just lower margin for error. If a company has really low margins, if one little mistake happens, it can be really problematic for the company and their earnings can swing negative. But companies that have really strong margins, strong gross profit margins, they can weather a storm. I'll give you a perfect example. Campbell's Soup right now, their overall profit margins are being strained a little bit, and that's because the cost of inputs right now is higher because of inflation. And so companies with a little better gross profit margin, they can weather such times when the cost of the inputs are a little bit higher. And so that's metric number 6. Metric number 7 is the net profit margin. Net profit margin is all the way at the bottom of the income statement. So whereas gross profit margin, it's calculated more towards the top of the income statement, net profit margin, it happens at the bottom of the income statement, and it's the net earnings divided by revenue. And so net profit margin gives an overall feeling of how profitable is the company. At the end of the day, when everything is done, when everything is said and done, how profitable is the company at the end of the day? And I like companies, again, just like the ones that have the high gross profit margin. I really like companies that have a high net profit margin because they can weather any storm. And also I would say a high net profit margin is signs that they're managing the business well. It's sign that they have a strong competitive moat. It's sign that just it's a really strong, worthwhile enterprise, and that it's a business that deserves to be in business. It's a business that has met its stride. It's a business that has stood the test of time. It's the business that, despite competitors out there, can continue to have really strong earnings. And so obviously this is very different by industry. Consumer packaged good foods companies like Campbell's Soup might have lower net profit margins than information technology companies like Apple. And every industry is going to be a little bit different, so it's important to compare by peer group. But you'll never really see me buying a company that has such a low net profit margin as like 5%. There's companies out there, I know, like automotive companies, like automakers, that some people like investing in as dividend stock investors. I won't buy an automaker because typically net margins at an automaker, like a Ford company, for example, they're really low, and it just worries me that in bad times, you can get squeezed and there can be no earnings because there's little margin for error. If one little thing changes, those margins are so razor thin. So I want to keep going. The next metric that I want to go over today, we're already up to metric now, number 8, is long-term debt. And so where I find long-term debt, again, is on the company's financial statements, and I pull that typically from their annual report, and I go to the balance sheet. I can get the gross profit margin, net profit margin from the income statement, and I'll show examples of that on the screen, or I have, now that I'm further along in the video, I will have shown those already as I'm in editing mode for this one, but I'll show a sample balance sheet right now as well, and balance sheet gives a sense of long-term debt. And I'll show a company I own called AbbVie. AbbVie has a reasonable amount of long-term debt because they recently made an acquisition called Allergan. They did that to diversify their business as their main blockbuster drug Humira goes off patent protection in the United States. But what I would say is, in general, this is a company that has a bit of more long-term debt, but they're doing what they can to pay it down. And in general, interest rates are low now, so companies are rewarded for taking on debt. But I would say, in general, as a dividend stock investor, I like stocks that keep their long-term debt manageable. And I also, more than that, like a trend on the balance sheet of seeing the long-term debt go down over time, certainly not up over time. I don't like seeing the long-term debt going up over time, unless it's a very specific situation. It's something very strategic, like what they had to do at AbbVie. They had to go ahead and buy Allergan as a defensive measure to diversify their business in face of that patent protection expiration. But in general, I like companies that keep their long-term debt under control, and if they do take it on, they take it on for very strategic reasons. So I keep my eye very, very closely on that number. So I want to keep going. The next metric that I look at as a dividend stock investor is the market capitalization. Now, there's nothing wrong with having a small market capitalization or a big one, but the reason I look at this is I like to have a diversified portfolio. I personally own 51 dividend stocks, and I own stocks of all sizes. I own them as low as, say, a few $1 billion market cap, and I own them as big as several $1 trillion like Apple. The key is, when I'm building my dividend stock portfolio, I don't just include all mega cap companies. I don't just include companies that are just one size. I diversify, and I have market capitalizations of all different sizes. And the way you can find market cap, I just find it on Yahoo Finance, actually. That's a great place to find the market capitalization. But just technically, how would you calculate something like that? The way that you do that is you look at all of the shares of the company, you multiply it by the price per share, and it gives you a sense of the market capitalization. And so I like to diversify there. I want to keep going. Metric number 10 that I look at really closely is I look on the statement of cash flows. On the statement of cash flows, what I like to look at is something called CapEx, capital expenditures. Any business has to invest in property, plants, and equipment. And that is not captured in net earnings. When you look at net earnings on the income statement, that is just how much the money the company is earning. But after they earn all that money, they have to go and invest property, plants, and equipment. And the way that they do that is through capital expenditures. That's calculated and computed on the statement of cash flows. And so what I like to look at is, I look at the statement of cash flows, and I like to look at the end of each period. Is cash growing or shrinking? Now, sometimes this can flip-flop around. It can be all over the place, but the long-term trend is I like companies where on the statement of cash flows, after dividends are paid, after CapEx is done, because dividends actually are not calculated in net income either. Dividends are after net income. And so I like to look after net income, after they paid out dividends, after they've paid through capital expenditures, is the company still earning some excess cash, if you will? Is cash and cash equivalents going up a little bit? Those are the companies I like the most, because there's an awful lot of companies that are positive on net earnings, but once they pay the dividend and once they go ahead and they also do capital expenditures, they're actually losing some money on the statement of cash flows. And so that's something really important to keep in mind as a dividend stock investor as well. So I want to keep going now. What is the next one? This is a fun one. I just like to look at the stock chart. And so from a stock chart standpoint, well, I'm a contrarian investor. I've always found that our world overreacts. It's kind of feast or famine. I'll give you an example. Most of the times when I've come to Hawaii here in the past, there's not that many people out in the morning like now. But right now, you know, it's very busy here this year, very, very busy, the busiest I've ever seen it. We actually went yesterday to the lavender farm here, and it was so difficult even to get parking. And so what I would say in general right now is it's the busiest I've ever seen it. Now, I think some of that is we're coming in June, and we usually come in different months. I think the kids are all out of school now, so that makes it a little busier. But what I would also say is with the pandemic being over, everyone has, you know, kind of moved on and they're ready to go all out on vacation. It's a time of feast. But I would say during the pandemic, the stock market was tanking, everyone was staying at home, it was a time of famine. What I would say is human psychology, feast or famine, unfortunately that's how human psychology is, and that plays out in the stock market. And so what I'm trying to say is a stock market investor, I always like to investing as a contrarian. I like to buy when everyone else is running, and so I look at a stock chart and I find world-class companies, but if I find a world-class company like Starbucks, for example, which I bought during the pandemic in the $50 a share range, and now it's over $100, I bought it when everyone was saying no one would go to Starbucks anymore. That's when I bought it. I bought it when everyone was scared of Starbucks. Am I buying it now when Starbucks is going towards all-time highs? No, I'm not buying it now. And so I just like to incorporate an element in my stock market investing strategy of contrarian investing. It's really important as an investor to be a contrarian and to buy when others are headed for the hills. Now, that's not what I do every step of the way. Sometimes I will just buy fair value when I'm buying and accumulating a world-class position. There's certain positions in my portfolio that I love, like my number one favorite stock is Johnson & Johnson. That one actually persistently seems to be a reasonable value, but I don't really have to wait for the stock price to tank on that to buy it. But now as I'm a more mature investor and I have a bigger portfolio, I can stand to wait a little bit. I've built up all my core positions, and so I do generally wait for something that's really good to tank. Some stocks that I like right now that are tanking, that are on sale, are Kimberly-Clark. They make toilet paper, Clorox Company, and also Campbell's Soup. These are three companies that benefited from the pandemic. Now that the pandemic is mostly over, a lot of people believe that these companies don't have as much of a future. I realize that everything reverts to the mean and that people overreact one way or another. And so now that everyone is headed away from these types of stocks, I'm headed into these types of stocks. So I want to keep going. I have another metric for all of you. The next one is basically sales by geography. I'm an international dividend stock investor. I own stocks in my portfolio that are internationally based, like Danone. This is a French company. But what I also do is, even for my United States companies, I own one, Colgate-Palmolive. Most of their sales are happening internationally. I'll link in the description below, but when I compute my personal dividend stock portfolio, I like to look at the sales by geography, especially US versus non-US, and I do a weighted average on my portfolio. Again, I'll link in the description below if you want to download my entire portfolio. And you'll see I have really good representation with international dividend stocks in addition to US based. And it's not only that I own stocks like Danone that are based internationally, but I have US stocks like Colgate-Palmolive that do a huge amount of business internationally. And so I have one more metric in my guide today, and that is, let me get through my notes here in the breeze, sales by product. When I first started buying Apple, this is a perfect example. Huge amount of their sales are coming from the iPhone. I think it was like 60%. Because of that, because it was a kind of a single product company at that time, more or less, it was trading on discount, I bought it for a really good price. So sometimes it pays to buy when a company is not diversified. I bought AbbVie before they bought Allergan. I bought AbbVie when they were very dependent, even more than they are now, on Humira. Well, times have changed and I benefited from taking on that risk. But in general, I would say as a dividend stock investor, my overall strategy, it's to buy stocks either in the short run or in the longer run that have a variety of sales diversification across different types of products. Different products, they're not dependent on just one product, one flagship like Apple was on the iPhone. But now as Apple has matured as a company, we all know that they're not so dependent just on the iPhone. They have many different products as well. So they're doing really well with services. They're doing really well with servers and enterprise. They're doing really well with their Apple Watch. They're doing well with all different types of products. And so I was rewarded as an investor getting in before that, but I saw the vision. I saw that happening. And as a buy and hold investor, when I buy a dividend stock, I plan to never sell. I'm buying and holding forever, multi-generationally. Dividend stock investing for me is a multi-generational strategy, and I love dividend stock investing in companies that I believe are going to stand the test of time, and those that stand the test of time have diversification in sales. And sometimes it's easy just to speculate, hey, Apple's diversified because we know they have all these products, but if you actually look at the numbers, they're probably still quite diversified or quite dependent on iPhone. What I always do as an investor, I don't want to just follow my hunch. My hunch and my gut is helpful, it's good, but what I also like to do is I like to look at the annual report. And when I look at the annual report, they usually share how much sales, how much earnings are coming from the different product lines. And I like companies that are really well diversified. One of the companies I own, 3M company, is super diversified. They have I think 40 or 50,000 different products. And what's so cool about 3M company is that's another one I bought during the pandemic that everyone was saying it wouldn't last the test of time. It would not keep going. There's one analyst saying it was going to follow GE and have horrible problems. Well, now it's rebounded quite a bit. It's doing quite well. And so I did really well buying when everyone else was running. But also, this is a company I love because I know, hey, yeah, they did take a hit because they have a good percentage of their business in aerospace. But honestly, they have so many other products as well, like 40, 50,000 different products. And so I did well buying that diversified company. And that's a strategy that I love as a dividend stock investor. And so I hope today in the video you enjoyed this guide to dividend stock investing. These are just 13 metrics that I like. This is video 2 in my beginners series. I will link in the description below to video 1, and I'm going to have many videos in this beginners series. I hope it's also helpful for more seasoned dividend stock investors as a refresher or even providing some fresh ideas. I'm trying to go through here from point A to point B, how to become a successful dividend stock investor like myself. And I would not feel as comfortable as I do coming to Hawaii right now, enjoying this vacation, if it were not for dividend stocks. If I did not, obviously I still rely on my job income, and it's really important. And I'm even working on my job a little bit here while on vacation. It happens, it's okay, little percentage of the time. But having that backdrop of dividend stocks, one day they're going to pay for everything. Right now they don't, but they're growing every single day. And it sure feels good, and it makes vacation a lot more enjoyable to know that I have that backdrop of my dividend portfolio earning cash flow while I sleep here in Maui, Hawaii at the Westin Nanea. It is so exciting. And so everyone, please smash the like button if you enjoyed the video today. Also, check me out on Patreon. I'll link in the pinned comment below. I have a Patreon with a lot of exclusive content. Don't miss it out. And also, please don't forget to subscribe. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. Investing in the stock market carries a lot of risk. Also, all of the stocks mentioned in the video today I own. I am long Campbell Soup, ticker symbol CPB, AbbVie, ABBV, Apple, ticker AAPL. I'm long Kimberly Clark, KMB. I'm long Colgate Palmolive, CL. I am long Clorox, ticker CLX. And Campbell Soup, CPB, and any other stocks I failed to mention just now that I mentioned during the video. I own all of those stocks in my personal dividend stock portfolio, such as StarBucks, ticker SBUX, 3M, ticker symbol MMM. I love you all. Thanks for hanging in here today, even though the video is a little bit shaky. I hope that the background scenery made up for that. I love you all. Please subscribe. I will see you in the next video, and I'm going to continue this series, so make sure to hang in there. I have a very long and involved beginner's guide. This is only the second video in the series. See you all in the next dividend investing video.